Joining us now with more on the markets as the futures are backing off just slightly, Kara Murphy, Kestra Investment Management Chief Investment Officer. Kara, good morning. We've been talking about the somewhat surprising, perhaps, performance by the market year to date. Also, this month, we're pushing out perhaps the onset of an expected recession. The Fed, yeah, maybe it has more to do, but it's doing it kind of slowly and incrementally at this point. Earnings forecasts are kind of flattening out and not collapsing anymore. What does that setup say to you right now as we look into the second half?
Well, it's been interesting because so far this year, as you suggested, the economy has really been treading water and treading water for longer than what many had suggested at the beginning part of the year. But the challenge is that the market has been acting like the rescue boat's on the horizon, but we can't quite see the rescue boat just yet. You know, we've had incredible rally in the major indexes, driven by technology, a lot of excitement over AI. And, you know, as you mentioned earlier, earnings have been okay. The challenge is that PEs now are looking quite stretched. We're at 21 times forward earnings, and we haven't yet seen liftoff in the economy. And in fact, there's still a tremendous amount of uncertainty left. And we have all these traditional indicators suggesting that recession is actually on the horizon. So I think at this point, the market's looking a little precarious.
I think the S&P, if you're looking at the consensus 12-month forward, it's more like 19 times or 18 and a half, 19, if I'm not mistaken. Still on the upper end, perhaps, of this range over the last several years. I guess the question is, if the complaint is that the market has been too narrow and skewed toward just a few huge stocks that have been driving up the indexes, is not the valuation also unbalanced in that same way? In other words, it seems like a lot of cyclical stocks are not oblivious to the fact that we might have a bit of an economic slowdown.
It's true. We have a wide divergence in terms of both valuations and earnings expectations. But when we look out over the next 12 months, we still feel like the back end of those 12 months, earnings expectations are still a bit too optimistic. You know, in the fourth quarter, we're looking at potentially an 8% rise year over year. Calendar 24, analyst estimates have 10% increase, 25, another 10% increase. So it's hard to imagine a recessionary environment in a time when earnings are rising by so much. So you need to be able to square those two with that high valuation.
Maybe worth a moment to just talk about the kind of dramatic events over the weekend in Russia at the time when people, and I was, being contacted by people assuming this was going to have some kind of market impact. I'm not sure exactly through what mechanism it would really alarm the markets at this point. But how do you think that these events would get transmitted into the markets? Why are we having a quiet opening today, even in Europe?
It is quite remarkable. U.S. markets in particular have this amazing ability to look through a lot of geopolitical risk. I mean, even when you go back a year and a half ago, Russia invading Ukraine, we had a fair amount of geopolitical risk get priced into the market for a time, but then the focus quickly shifted to commodity markets. And higher commodity prices played very much into some, on-the-ground concerns of runaway inflation. So this time around, too, I think the main concern, at least for U.S. markets, is going to be focused on commodities. So, does a power struggle in Russia threaten energy supplies, threaten wheat supplies? And quite honestly, 18 months after the first invasion, we're in a much better place than we were in terms of protecting those commodity supplies. We've been able to find sources elsewhere. So this remains a risk, but I think that's really going to drive the transmission or potential transmission mechanism between Russia and U.S. markets.